and welcome to the CUInsight Network. My name is Robbie Young. I'm the Vice President of Strategic Growth at CUInsight, and it's my job on this show to have conversations with thought leaders who support the credit union community. We'll identify issues affecting credit unions and discuss best practices that help us learn from one another and strengthen our credit unions. My guest on today's show is Dan Hanks, SVP Global Product Management, and Geoff Dean, Director of Commercial Product Management at i2c. Dan, Geoff, thanks so much for being here.
Oh, thank you.
Glad to be here.
So starting with you, Dan, and then Geoff, I would love to hear from you as well. For those who may not be familiar, can you share a little bit about i2c and how you're supporting credit unions?
Sure. So i2c is a global issuer processor. Credit unions, people are probably familiar with that concept. We're more what's considered a next gen as opposed to the older legacy types. We're headquartered in Silicon Valley. We like to say, we're a fintech, but we're not new. In fact, we're celebrating our 25th anniversary this year. But we provide support for credit unions, banks, and fintechs around the world in terms of processing of multiple products. So we do credit cards, debit cards, prepaid, core banking, money movement as well, and support a number of credit unions as they self-issue cards.
Anything you want to add to that, Geoff?
No, I think Dan did a great job talking about who we are. And we do support, as Dan mentioned, consumer and commercial. And on the commercial side, it's from the business banking clients to middle market and all the way up to enterprise level.
For credit unions evaluating their card programs, how do self-issuance and agent banking models differ from what's driving the growing interest in self-issuance today?
Sure. And for most small and even mid-sized credit unions, agent banking has been a traditional way to do it. For an agent banking is much simpler. You work with an agent bank, they issue the credit cards, they take all credit risk, they also take the revenues off of it. Generally, the credit union will have a product to sell. It'll be the credit union logo that they can offer to their members. They'll usually get a commission per card and perhaps a small bit of the spend going on afterwards. So it's a much simpler model to do. Self-issuance, just like for larger banks, means you issue yourself. You are responsible for everything end to end. We're seeing self-issuance become much more popular for mid-size and even some smaller credit unions. The downside of the agent bank part is that while it's simple, a few things. You lose control of the member experience. Right? You have no control. It's really completely managed by the other bank that you're working with. Often have less competitive products. That's what we see generally in the marketplace with agent banking. And also, it is less profitable. Credit cards are profitable products to have. So being able to do it successfully helps fund other offers and other products that you have for your members.
Yeah, when you look at the agent banking, to Dan's point, there's a couple different flavors, whether it's a complete referral outsource or even another type of approach where it's more of a sponsorship type of arrangement. But in both the scenarios, you do lose control. And so there's wanting to kind of deepen those relationships. If you think about the benefits, right, there's certainly the revenue and control over the program. It's also deepening those client relationships about the client experience, being able to be closer to your clients and provide more consultative services and value add to the clients. So I think those are the key things. Additional, product customization. You really don't have any product customization when you're outsourcing, or it's very minimal. And it is more of a one size fits all. And so particularly when you get in the commercial space, there's a lot more need from the member business clients to get more customization in their card programs.
That's such important information to have on that. From member experience perspective, what advantages can self-issuance provide, and how does it help credit unions strengthen member relationships?
Yeah, and the member experience is really one of the key drivers that we're seeing towards self-issuance from credit unions. Obviously, the member relationship is so critical, right? Why does a person become a member of a credit union as opposed to just a customer of a bank? And it's really because of that membership, that feeling, that loyalty that's generated, that more personal relationship. And that's really what you risk because you really have no control. So, for example, you have no control over the underwriting. You might know this as a member, it's been with you for a long time. You might feel they're a very safe customer. But when they apply, all the other bank knows is a FICO score, right? And what they can pull off the credit bureau, and you could get declined. If they're blocked when using the card, authorization declines. There's really nothing the credit union can do to even help with that. If you come into a branch and say, why did this happen? Or I'd like, can you help me with this? They generally can't, right? Because they're not actually managing it. The danger is that, the member doesn't really understand that, right? The member thinks, I went into my credit union, I applied for a credit card, I got the credit card with the credit union logo on it. So logically, this must be from my credit union. Right now, we know in the background for an agent banking relationship, that's not really how it works. But the member won't understand that. So if there's anything negative from a bad call center experience to card blockage or anything else, the blame is really going to go on the credit union. And it could potentially damage that relationship they have. And obviously, that relationship piece is critical, right? Because it's really the credit union brand that'll be damaged by it.
Yeah, and the other thing I'd mention too is it really provides the credit unions the ability to respond and resolve member requests more quickly. Dan mentioned the credit is a big part of these card programs, and when it's completely outsourced, then the ability for the partner, the outsourced partner, to help those members is limited. So that's a huge part of being able to support the businesses.
Could you share what that looks like in practice?
Sure. Yeah. I mean, if there's a company that needs, for example, needs more credit on their program to be able to do more, as Dan had mentioned, they call into that number on the back of the card and it's outsourced to an agent bank. The agent bank really only knows this client for the card program, right? They don't have a broader view of that credit relationship. And so the agent bank might say, look, we're not able to increase your credit line for these reasons. And they'll leave it at that. And then the client might very well come back to the credit union and let them know what's occurred. And then the credit union has a better look and a better feel for what that business is doing and what their cash flow might look like, the people that are managing it, the different strategic initiatives that they have underway. And so having that broader view, having a direct issuance with that customer could very well have just resulted in an increase in credit without all of the additional phone calls. And even after they make the phone call to the credit union would still have to go back to the agent bank and speak with them and see if they're willing to do the credit increase, or if the credit union might have to provide some sort of guarantee on the credit risk. So in general, there's a lot of improvement in terms of the connectivity and being able to assist those business clients.
So how does moving into self-issuance model change the way that credit unions manage key business relationships across their payments ecosystem?
Yeah, and one thing we see with credit unions too, moving into this, is in some way it's a bit of a defensive play, right? So if let's say you don't have a competitive credit card product, you're very basic and most of your members will be using someone else's. The danger is that, the banks that issue those cards that your members will be using might try to take more of the relationship. So let's say your member is using a Wells Fargo card. If there are Wells Fargo branches in the area where you are, it's very likely that before too long, they're going to start cross-selling other banking services, checking, savings, auto loans, potentially mortgages, and so forth, and trying to take the whole relationship. And ultimately, members love the relationship they have with their credit union, but they still need competitive products, right? So, you might still like your banking at the credit union, but if that Wells card or someone else's card is just much better, say as a credit card for rewards and so forth, or maybe for other features it has, goes more easily into into your virtual wallets like Apple and Google and so forth, they'll use those cards. And then that's letting another bank or another financial institution or even potentially another credit union actually, put their foot in the door, right? Get in with the relationship with your member and potentially take them away. So, in addition to the benefits of, strengthening a relationship with self-issuance, it can just be more of that defensive play. Because when you self-issue, you have more control over it, right? You can have a richer product. You can have a better rewards program than you might get for an agent bank. And that will keep your members loyal to you and using your products across the board.
So it's not just about cards.
No, exactly. Cards is the first step. But if you're a credit union and they use somebody else's credit card, you can live with that, right? As long as they do the rest of their banking with you. But that's the danger, right? That it's not just credit cards, that could be the first step to losing the entire relationship and then losing deposits along with it.
For credit unions considering self-issuance, what foundational capabilities, whether technology, talent, or operational readiness, should be in place to be successful?
Yeah, I think one of the key things is you need to find the right partner. Cards are basically a scale business, and that's why many smaller to even mid-sized credit unions never self-issued in the past. It's also some of the larger legacy processors had less interest in some of the smaller players in that. But you really need to find a partner with the modern platform, with modern technology, all the the features, all the bells and whistles that your members would expect. But then that can also provide end-to-end servicing, right? So someone who can do credit cards or other cards, or also things like you need to provide call center services, fraud, which is especially critical as the credit union would take losses from that, disputes, statements. Think about everything with a credit card, say end-to-end, to have a partner that can do all of that with you so that you can leverage their scale, right? So that you don't have to build it up. Now, we see credit unions we have some with i2c, for example, who like to take some pieces in-house. Let's say they already have an existing call center and they want to just keep using that. So, we're very flexible. We work with our partners with that. But ultimately, there will always be some capabilities, some features that you don't have in-house. And you really need to make sure you have the right partner who can deliver those.
Yeah, and I think from a technology and perspective, and Dan mentioned flexibility and integration, but it's really, especially as the credit unions are maybe going up market a little bit more into the middle market clients that have a little bit more complex businesses, the ability to have a platform that can handle those complex structures, that have the real-time spend controls and can do additional types of solutions like virtual card issuance or integration with ERPs and accounts payable systems. These modern day processing platforms have made it a lot more easier for the credit unions to integrate and offer these additional services.
As we wrap up the show, I would love to ask if you have any final thoughts or anything you'd like to share with our listeners.
One thing, we've seen with a number of clients and other credit unions we work with is to be open to the idea of self-issuance. There are some, especially from the past, where it just wasn't economically feasible, or with the large legacy providers, it really just wasn't possible to do it, and it was just something off the table. There are far more possibilities today than there were even in the past. So I think that's the first thing. Now, for some very small credit unions, it might always make more sense to stay with the agent banking approach. But even some smaller credit unions who, would have in the past thought they were too small, are able to do so successfully. So I would just say that, definitely keep your mind open to the possibilities here.
Yeah, and I would just add that with direct issuance, it offers credit unions the ability to have more touch points and connect with their members to help solve business challenges, not just with cards, but with the full breadth of services that are available. That really kind of moves the credit unions from just a product provider for card into a more strategic partner to help them solve business challenges.
Well, thank you again, Dan and Geoff, for being on the show. For episodes like this one and more from across the credit union movement, visit CUInsight.com to read, explore, and subscribe. Stay well, and thank you all of our listeners for tuning in today. We'll be back again next time.